Hey everyone, this video that you are going to be watching now is probably going to be quite a long one, or split into many parts because of the 15-minute limit that I have on the free version. But what we're going to be looking at is going through the slides of CGT. This is work that we mostly finished in the last week of class before the lockdown and exams. I mean, not exams, what am I talking about? Before the lockdown and before the break. So I'm going to be going over everything again. For some of you, it might be a bit of repetition. For others of you, it might be the first time that you're seeing it, but I think it's going to be good. This work can get technical, so if at times you need to pause, please do to work through the examples. There'll be other times when I will ask you to pause to work through certain things. So yeah, please do that. And as always, if you've got questions, if anything's not making sense, the textbook is your friend, as well as am I. So if you need anything, just send me an email, post it on a Canva, whatever it might be, and I'll get back to you as soon as we can. So yes, I'm going to keep this here. Makes my face half in the blue and the black, but we'll make it work. And yes, so what we're going to be looking at over the next few slides is CGT, capital gains tax, and it's very important to remember that CGT is found mostly in the 8th schedule of the Income Tax Act. That means it comes after the main body. It means it deals with specific, each section deals with a specific thing. The 8th schedule deals with CGT, but it's still part of the Income Tax Act, and it still uses everything else from the Income Tax Act. It's just put in one nice place for you. And the way we're going to do this, we're going to look at the basics to start, and then we're going to go over CGT section by section in the 8th schedule, and basically I'll let you know what's examinable for psycho, what's not, and hopefully that way we'll get everything done. It might be good to actually sit with your act, with your legislation, and work through it section by section to make sure what you've got highlighted, flagged, all those kind of things make sense to you. So, as a background, I'm also just realizing I can't see how long it's been. So I'm going to do this. You should still be able to see anything. If anything gets cut off at the bottom, I will make sure that we get to see it. So, remember, CGT came into effect 1st of October 2001. This is a bit of recap from second year that you did. What CGT is, it's basically going to be whenever you have something which is of a capital nature. Remember back to your gross income definition. You had amount in cash or otherwise, received or accrued during the year of assessment. You had the stuff about residence, all those kind of things. And then it ended off with saying not of a capital nature. You also should remember that an item is either capital or it's not, or it's revenue. So something's either going to go, if it's an amount received, into gross income, or it's going to be subject to CGT. Now, before 2001, there was no CGT. So if something was sold and it was deemed to be capital, there was no tax. If it was not capital, there was tax. So it used to be a big fight. Now, however, those amounts, the fact that we have CGT means that something which is capital is going to be taxed. We'll learn later that for a company, it's included at 80% of its full value. For an individual, 40%. So the effect is not as big as it used to be. Before it was taxed or not taxed. Now for a company, it's either taxed or taxed at 80%. So what you're going to see is that the fights that used to exist about whether something was capital or revenue, not as big of an issue anymore. But you still do need to know. Okay. Where does it all fit in? We got to remember with CGT, how CGT works is we're going to work out one number that's going to represent your net capital gain for the year. So it's going to be all your transactions brought together, and it's only going to be included once. So in your taxable income framework, only one number for CGT actually ever goes in. Now, for CGT, you have to remember there are 4 key elements that you need. You need an asset which is disposed of, which has a base cost and has proceeds. Sometimes those proceeds or base cost may be nil, so that's not always the biggest issue, but you have to have an asset which is disposed of. Then what we need to see is the process. The key process here, what you're going to do you're going to add up all of your capital gains for the year. So you're going to work out capital gain on asset 1, capital gain on asset 2, capital gain on asset 3, add them all up. You're going to work out your capital losses, however many you had in the year, and you're going to set them off against each other. Once you've got the sum of all of your gains and all of your losses, you are then afforded a 40,000 Rand annual exclusion. Okay. Note this is only for natural persons and special trusts. It's not for companies. And another key thing to remember, I'll talk about it in a little bit, it's an exclusion. Okay. Once you've taken off that 40,000, you get your aggregate amount. You take off any capital losses brought forward from a previous year. That gives you a number, and you multiply that by 40 or 80%. 40% for a natural person, 80% for a company. That gives you the one number that is brought into your taxable income calculation. Okay. Now, some special things about this. These are the things that are often mistakes. These are the things you have to pay very special attention to. So let me ask you the following questions. Cool. Firstly, what happens to the annual exclusion when the taxpayer dies? Well, if you die in the year of assessment, that annual exclusion increases. Okay, so it increases from an amount of 40,000 and it goes up to an amount of, I hope I'm remembering right, and I'm pretty sure I am, 300,000 Rand. Okay, now the next question, why is it called an exclusion and not a deduction? And this is very important. Think about the difference between the words exclusions, exemptions, deductions, rebates, words you may use interchangeably because they mean similar things, but in actual fact they are all very different. And when you are writing an answer in tax, you have to make sure that you're using the right word. I've marked board exams for the last 4 years or so, 4 or 5 years, and when you're marking tax, it's very important. If you write the word exclusion instead of deduction, or if you write the word deduction instead of rebate or anything like that, you don't get the mark because you're talking about the wrong stuff, especially in discussion questions. So you need to be very specific with the words that you use. In this case, it is a 40,000 Rand exclusion. Now, an exclusion means the following. It will reduce whether you have a gain or a loss by an amount of up to 40,000 Rand. That means if the sum of all your gains and losses is 100,000 Rand, the exclusion will bring it down to 60,000. If it is an amount of 60,000, it'll bring it down to 20. If the sum of all your gains and losses is 5,000 for the year, it will bring it down to 0. It will never take it from a gain to a loss. So in this side of things, having the exclusion is actually a bad thing. Or no, in a gain, it's going to be a good thing. My apologies. It's going to make the gain smaller, so you are going to have to pay less tax. However, on the other side, if you made a loss for the year, this annual exclusion is going to actually make your loss smaller. It will make a loss of 100,000 go to a loss of 60. Will make a loss of 60 go to a loss of 20. And it would make a loss of 5,000 go to 0. Okay. So if you're making a small loss in the year, it's actually going to reduce your loss to 0. So it's not always going to be a good thing. Why does it exist? Stop SARS dealing with small numbers. So if you make a gain or loss of a couple $100, you don't have to actually worry about it. Now, a bit of personal here. I'm recording this during the lockdown when all the shares in South Africa have tanked. So that meant my shares dropped in value, which means I decided to sell some, I decided to keep some, and that meant I made losses on these shares. These would be capital losses. But the problem is, in the current year, I have no capital gains to set them off against, and my losses are definitely under 40,000. I don't have that much to invest. So what's going to happen is at the end of the tax year, the annual exclusion is going to eat away those losses, and basically they have no effect on me. All right. The other thing that's quite important to remember is if this number over here works out to be a loss, You never ever, 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 ever multiply that loss by 40 or 80%, and even more never, ever, evers, do you ever stick that number into your calculation. That loss, whatever number you calculate, is carried forward to the next year and is set off as this line over here. You should never ever be multiplying a loss by a percentage, and you should never ever be putting that net loss into a actual taxable income calculation. Anytime there is a loss, it's going to be carried forward. Okay. How it all fits together, I want you to read this example that comes from the textbook, and the key things that I want you to take from it is the layout of how everything looks. Okay, we start off here with other taxable incomes. That's just everything else. Then we have the actual, allowances, recoupments, things that happen in taxable income. I don't mind if you put these in both, each line on its own or net them off. I'll probably put them in each line on its own. But what I care about here is the CGT format. So how I want it to basically look is I need you to be very specific to show me when you are doing the calculation for CGT, it must not be in the same line as taxable income, because I need you to show the marker that, hey, I know that this amount is not part of taxable income. The selling price does not go into gross income. The cost price is not deducted. This is a separate calculation. In this scenario, you've got the selling price, and remember for CGT, the definition that we're going to do in a bit more detail later reminds us that it's going to be selling price less any amounts which were included in taxable income, gives you proceeds as defined, and your base cost as defined is your cost price less any amounts that were deductible from taxable income. So when we look at this scenario, we're going to see that we sold it for $650, but we had a recoupment of $200 over there that went into taxable income. So your net proceeds, or your proceeds as defined, is $450. Your cost price, what you paid for the asset, less all of your allowances. Now key, this is going to be all of your allowances over all of the years relating to this asset. Okay, up top it's only going to be the current year. So when we have our cost price less all the allowances we've claimed, that gives you your base cost. Proceeds less base cost equals your capital gain. What you then need to do is think about, are there any other capital gains or losses that exist? You need to add them together. So when you're doing this kind of thing in a longer question, you actually just have to leave your CGT until you get to the end to see if there's any other gains or losses that may appear. You then add those all together. You take off your exclusion if one exists. In this case, it is a company, so there is no exclusion. You multiply this number by the inclusion rate, and that is the number that goes into your taxable income calculations. Okay, so a few tips and tricks to remember. This number here and this number here are generally going to be the same. Not always. There are some circumstances where they are not. But remember, your recoupment is 9 times out of 10 going to match whatever your allowances over the previous years were. So not always, but just be on the lookout that these two should probably be matching. Your recoupment is always going to be there in the current year. Your allowances will not match the number above because it's over multiple years. Okay. Other things, if there is a deferred recoupment, this is the total amount that is going to be included. Okay, so if there's a deferred recoupment, the whole amount still comes in here. Last thing to remember before I end the first video is that you are only ever going to see the annual exclusion when you are having a natural person. So whenever there's a 40,000 exclusion, the rate will be 40%. There should never be an 80,000 and a 40,000. So remember, if there's a 40, 40% inclusion. If there's no 40, 80% inclusion. And that's the basic process of how CGT works. We're going to carry on in the next video as we start to get into some more of the specifics.